hello and welcome. I was sitting with my grandson the other day, and he was showing me this little slab of glass and metal he keeps in his pocket. His phone. A marvel, really. He was swiping through photographs that looked more real than my own memories, talking on a video screen to his friends, scattered halfway across the country, and with a few taps, he could pull up any piece of information known to man, from the recipe for his grandmother's favorite apple pie to the orbital velocity of Jupiter. It's all just there. In the blink of an eye, it holds more raw computing power than all of NASA had in its entire command center when they first sent our brave boys to the moon. And it got me thinking we live in an age of incredible visible change. You can see it, you can feel it, you can touch it. The technology evolves right before our very eyes, year after year. Cars are starting to drive themselves, for goodness sake. You can ask a little plastic box on your kitchen counter to play any song ever recorded, from Frank Sinatra to that new fellow, what's his name? And it just does it. It's magic. The most profound changes, the ones that truly fundamentally alter the course of our lives, our security, our entire future, well, often silent. They're invisible. They don't announce themselves with a flash and a bang. They creep up on us slowly, quietly, day by day, like the tide coming in across a vast flat beach. You don't notice it from 1 minute to the next. But after a few hours, you look up and realize you're surrounded by water. That's how it is with the great financial shifts. Until one morning, you wake up, look around, and find that the world you spent a lifetime preparing for is no longer the world you live in. The very ground beneath your feet has changed. For the last 50 years, a generation of Americans, my generation, a generation of seniors now, did everything right. We followed a very simple, very sensible, and very honorable set of rules for a secure retirement. It was a playbook handed down to us by our parents, and it made perfect sense. It was the American way. You find a good job, you work hard, you show up on time, you give an honest day's work for an honest day's pay. You live within your means, you avoid foolish debts. You save your money diligently, week after week, month after month, year after year. You put those savings into what you were told was a responsible, balanced portfolio, a mix of good, solid American businesses, the engines of our prosperity, and what we were all told were the safest assets on planet Earth, government bonds. The full faith and credit of the United States of America. You build your nest egg, that precious store of capital, with the solemn promise that this combination of growth from stocks and safety from bonds would see you through your golden years, come what may. It was a contract between us and the financial system. That was the playbook. And for a very long time, it was a good playbook. It worked. My goodness, it worked. It built the most prosperous generation of retirees in the history of the world. But I am here to tell you today, with as much seriousness and gravity as I can possibly convey, that for millions of American seniors, that playbook is now broken. The promise has been voided. The contract has been breached. And the very foundation of that promise, the bedrock of safety upon which we built our entire retirement, has been turned into a trap. A silent, slow motion trap that is draining the lifeblood from your savings as we speak. The popular belief, the one that is still chanted like a mantra by a great deal of the financial industry, is that a government bond is the safest investment a person can make. I am telling you today that for the foreseeable future, that belief is not just wrong, it is profoundly, dangerously, and ruinously wrong. The single most terrifying threat to your financial security is not the loud, headline-grabbing volatility of the stock market. It is not the scary red numbers that flash across the screen on a bad day. The greatest threat is the quiet, mathematical certainty of loss that is now embedded in the very assets you have been told for your entire life are your safest harbor. And the most frustrating part of all this isn't a guess. This isn't a guess. This isn't some wild prediction from a doomsayer on the internet. It is simple, unavoidable, first-grade arithmetic. By the end of our discussion today, I'm going to lay out exactly why this is true. I'm not going to use fancy Wall Street jargon or complex formulas. I'm just going to use simple, common sense math that anyone can understand. And then, and this is the most important part, I will share the only genuine time-tested defense I know of against this silent, creeping threat to your retirement. Let's just go back in time for a moment to understand how we got here. It's important to see the whole picture. For the better part of 40 years, from the early 1980s right up until just a few years ago, the entire world of finance was powered by a huge, wonderful, and invisible tailwind. It was like sailing with the wind and the current at your back. You hardly had to paddle, and you still moved forward at a good clip. You see, back in the late 1970s and early 80s, we had a terrible, terrible problem with inflation. I remember it well. Prices were running wild. You'd go to the grocery store, and the price of a loaf of bread would be different from one week to the next. It was a cancer on the economy. To fix it, the Federal Reserve, under a tough old bird named Paul Volcker, a man who stood 6'7" and smoked a cheap cigar, a real force of nature. He had to do something drastic. He had to perform surgery on the economy. He jacked up interest rates to punishing unheard of levels. I remember interest rates on government bonds being in the double digits, 14, 15%. It was a painful time for a lot of people, a deep recession. But he did it. He broke the back of inflation. And once he did, those incredibly high interest rates began a long, steady 4-decade march downwards, from 15% to 8% to 5% down and down and down, all the way to nearly zero just a few years ago. And this 40-year decline in interest rates created a paradise for a certain kind of investor, specifically the bond investor. You have to understand a simple mechanic of the bond market. It works just like a seesaw. When new interest rates in the market go down, the price of your existing, older, higher rate bonds goes up. It has to. If you have a bond that pays you 8% and the new bonds being sold only pay 4%, your old bond becomes much more valuable. Someone will pay you a premium for it. So for 40 long years, if you owned bonds, you were winning twice. First, you were collecting a steady, reliable stream of income from the interest payments. And second, the bonds themselves often went up in value as interest rates fell. They were the perfect complement to stocks. If the stock market had a bad year and went down, your bonds, cushioned by falling interest rates, would often do well, softening the blow to your portfolio. This is where the gospel of the 6A40 portfolio came from. 60% in stocks for growth, 40% in bonds for safety, income and stability. And my goodness, it worked like a charm. It delivered good, solid returns with a whole lot less volatility than an all-stock portfolio. It was absolutely the right strategy for the time. It was the sensible, prudent, and correct thing to do. The problem, you see, is that a 40-year trend starts to feel like a permanent law of nature. It's like the sun rising in the east. You just expect it to happen. People, including many professional financial advisors who have only ever worked in this environment, mistake a long-running cycle for an eternal truth. But that cycle is over. That wonderful tailwind that gently pushed our portfolios forward for 4 decades has now turned into a vicious, biting headwind We have entered a new era, an era of higher, more stubborn structural inflation, and as a result, a new era of higher interest rates. And in this new world, the old rules of safety are not just obsolete. They are a trap. The first part of this trap, the part we all feel every day, is inflation itself. I've heard Warren Buffett call inflation a tapeworm on the economy, and that's the best, most visceral description I've ever heard. It's an invisible parasite. It lives inside the economy, and it silently, secretly eats away at your purchasing power. A dollar is still a dollar in your hand. You can look at George Washington's face on it, but what it can actually buy for your family shrinks day after day after day. It's a silent robbery. The government will come out with its official numbers, the Consumer Price Index, the CPI. They'll tell you inflation is, say, 3% or 4%. And maybe for some people, for a young family buying the latest electronics, maybe that's true. But for seniors, the real rate of inflation, your personal inflation rate, is often much, much higher. And this is a critical distinction that almost no one on Wall Street talks about. That official CPI number is a basket of goods designed for a typical urban family. It includes things like computers and big screen televisions and smartphones, things that, because of rapid technological advancement, tend to go down in price over time. That technological deflation helps to hold the overall index down. But let me ask you, what are the biggest, most unavoidable, non-negotiable expenses for a senior citizen? It's not a new television. It's healthcare, doctor's visits, prescription drugs, insurance premiums. It's housing, whether that's rent or the ever-rising property taxes on a home you've owned for 30 years. It's food, the basic staples of life. It's the energy to heat your home in the winter and cool it in the summer. And the inflation in those specific categories, the ones that make up the bulk of a retiree's budget, has been running far, far higher than that headline number you see on the evening news. Your personal inflation rate isn't some abstract government statistic. It's the number you see on your hospital bill after a simple procedure, a bill that seems to double every few years. It's the number you see at the grocery store checkout for the same basket of goods you've been buying for a decade. It's the number on your utility statement every single month. And that rate is punishing. It is relentless. I'd be curious to hear from you all in the comments. Just think about one thing you buy regularly. Maybe it's a specific brand of coffee, or a loaf of bread, or the cost of a haircut. How much did it cost 5 years ago, and how much does it cost today? The difference is your reality. And while we're on the subject, have you noticed the boxes getting smaller? They call it shrinkflation. The price of the box of crackers stays the same, but you open it up, and there are fewer crackers inside. The ice cream carton looks the same, but it's a few ounces lighter. It's a sneaky way of raising prices without you noticing. Another way the tapeworm gets its meal. Let me know in the comments if you've spotted this particular brand of thievery on the grocery shelves. Think about it this way. A fixed pension of, say, $2,000 a month sounds pretty good, doesn't it? It's a reliable check. If your real personal inflation rate is just 5%, and for many seniors, particularly with healthcare costs, it's higher. In just 10 years, that same $2,000 check will only buy you what about $1,200 buys today. Nearly half of its power to provide for you will have vanished into thin air. It will have been consumed by the parasite. Now, you'll say, but Social Security has cost of living adjustments to call us. And that's true, and thank goodness for them. It helps, but those adjustments are based on that official lower CPI number. the one that includes the falling price of televisions. It rarely keeps up with the real world costs that seniors face, particularly the staggering out of control inflation in healthcare. It's a cushion, but it's not a shield. Inflation is a tax. It's the most vicious tax of all because it's a tax on the prudent. It punishes the very people who did everything right, the people who saved their money, who lived within their means, and who are now living on a fixed income. It is a government-sponsored, silent confiscation of your wealth, and it is happening every single day. Now, that brings me to the second and far more insidious part of this trap, the bond market itself, the safe part of your portfolio. This is where the math becomes truly terrifying. Let's do some simple, first grade arithmetic together. Let's say you go out today and you buy a 10-year U.S. Treasury bond. You are lending your hard-earned money to the United States government. It's the safest credit in the world. They will not default. They have a printing press. After all, you will get your interest payments and you will get your principal back in 10 years. For that privilege of lending them your money, you will receive an interest rate of, let's call it 4.5% for our example. That sounds safe, doesn't it? It's a guaranteed return. The word guarantee is very comforting. But wait a minute. Let's use our simple arithmetic. If your real personal inflation rate, the one based on your actual expenses, is 5% and your safe A government bond is paying you 4.5%, what is your real return? What is the actual change in your family's purchasing power? It's negative. It's a negative half of 1%. Let me repeat that because it is the single most important financial fact for a retiree in America today. By investing in the safest asset, you are losing 1/2 of 1% of your purchasing power every single year, and you are guaranteed to do so for the next 10 years. You have locked in a decade of your savings becoming worth less and less. The bond is not a safe harbor. It is a locked room where your money is guaranteed to shrink. You have traded the volatility of the stock market for the certainty of losing purchasing power. And I ask you, which is the greater risk to your long-term security? A temporary drop in the price of a great American business that history shows will recover, or the slow, certain, irreversible erosion of your family's capital, guaranteed by the full faith and credit of the government? This is the terrifying message. The part of the financial world that was designed to be your anchor in a storm is now a source of guaranteed leakage. For decades, you were paid a premium to take on the safety of bonds. Your yield was higher than inflation. Now, you are paying a penalty for it. Your yield is lower than inflation. The world has been turned completely upside down. The frustration is that it's all hidden behind what they call nominal numbers. Your account statement looks fine. It says your bond is worth $1,000. It says you received your $45 in interest for the year. Everything looks stable and secure. But the reality, the on-the-ground reality of what that money can buy for your family, the groceries, the healthcare, the gas in your car, that story is a different story entirely. And that is the only story that matters. And why is this happening? We have to ask the hard questions. Why would a government issue bonds that pay less than inflation? Well, think about who the biggest debtor in the world is. It's the government itself, with a national debt that is now measured in the tens of trillions of dollars. A government with a massive debt has a very strong, albeit unspoken, incentive to have inflation run a little higher than the interest rates it pays. Why? Because it allows them to pay back their enormous debts with cheaper, devalued dollars in the future. Your loss, in a way, is their gain. It's the only way they can manage the enormous pile of debt they've accumulated It's a sobering thought. And as if that weren't enough, there is a third wave to this storm that is gathering strength. And that is the combination of human longevity and the staggering cost of long-term care. It is a wonderful thing, a true miracle of modern science and better living, that we are all living longer. My grandfather, if he lived to be 75, was considered an old man. Today, it's not uncommon to see people living well into their 90s. But this wonderful gift of time has a very long and a very, very expensive tail. The last few years of a person's life, when they may need assistance, can be extraordinarily costly. A recent study I saw from a reputable insurance company put the median cost of a private room in a nursing home at over $110,000 per year. A home health aid to help with daily living can easily cost $50,000 to $60,000 a year. These are not small numbers. This is the kind of expense that can vaporize a lifetime of diligent savings in a shockingly short period of time. So you have this perfect storm brewing for seniors. Your income streams from pensions and bonds are being systematically devalued by the silent tapeworm of inflation. Your biggest expenses, particularly for health care and long-term care, are inflating at a rate far faster than the headline numbers. And you are likely to live longer, meaning you need your money to last longer than any previous generation in history. This is the new reality. And the old playbook, the 60 of 40 portfolio, is simply not equipped to handle it. It's like trying to navigate the North Atlantic in a rowboat. It might have worked in a calm sea with the wind at your back, but in this new, stormy environment, it's a recipe for disaster. Now, there is a class of asset, a type of investment that is specifically designed to thrive in this kind of environment. It's the only true long-term defense against the tapeworm of inflation. And I'm going to describe its key characteristics in just a few minutes, because understanding them is the key to rewriting your own playbook for a secure future. The psychological problem we all face, and I face it too, is that human beings are wired by millennia of evolution to fear the wrong things in the modern world. We fear the sudden shock. We fear the market crash, the headline that screams, Dow plunges 1,000 points on the front page. It's like a lion roaring in the jungle. It gets your attention. It triggers that primal fight or flight response. Your heart pounds, your palms get sweaty. And so people panic. They call their broker. They sell at the bottom. They do the exact wrong thing at the exact wrong time, turning a temporary drop into a permanent loss. But the far greater danger, the one that does the real permanent, soul-crushing damage to a retiree's portfolio, is not the lion, it's the termites. It's the silent, invisible chewing away at the foundation of your house, day after day, week after week, year after year. Inflation. You don't get a screaming headline that says, your purchasing power dropped 0.01% today. So you ignore it. It doesn't feel dangerous. And by the time you see the visible damage, the sagging floor, the crack in the wall, it's too late. The foundation has crumbled beyond repair. I am truly curious. And I'd ask you to be honest with yourself and maybe let me know what you think down in the comments. Which of these two scenarios genuinely worries you more? A sudden 25% drop in the stock market that history has shown time and time again in 2008. In 2000, in 1987, always recovers, or a guaranteed 1% or 2% annual loss of your purchasing power every single year for the next 10 or 20 years in your safe A investments. I think most people would instinctively say the market crash. Our brains are wired for that. But the cold, hard math shows that the slow, certain, grinding bleed is far more dangerous to a long-term retirement plan. A crash is a storm. A negative real interest rate is a change in the climate. So what is the solution? If the old definition of safety, the absence of price volatility, is now a trap, what is the new definition? The new definition of safety, the only one that truly matters for a retiree, is the protection and growth of purchasing power. A truly safe asset is not one whose price never goes down. A truly safe asset is one whose earning power goes up over time and goes up by more than the rate of inflation. And that brings us to the antidote. The only place you can consistently find that characteristic is in the ownership of wonderful businesses. Stocks. Now, hold on. Before you click away, hear me out. I am not talking about speculating. I am not talking about day trading or chasing meme stocks or trying to guess which hot new technology company is going to be the next big thing. That's gambling, and it has no place in a retirement portfolio. I am talking about becoming a part owner, a silent partner in durable, established American businesses that provide essential goods and services that people need and want in good times and in bad. Why are these businesses the antidote to inflation? It comes down to one simple, powerful concept: pricing power. Think about a company like Coca-Cola. Berkshire has owned it for a long, long time. If the cost of aluminum for their cans goes up, if the cost of sugar goes up, if the wages they pay their employees go up, what do? They raise the price of a can of Coke by a few pennies. They have to protect their profit margins. And because you and billions of people around the world have a certain feeling about that product, that little bit of happiness in a red can, you pay the extra few cents. You don't even think about it. That pricing power allows the company's revenues and, more importantly, its earnings to rise right along with inflation. The business acts as a natural hedge. Its earning power is not fixed like a bond coupon. It is dynamic. It adapts. It's a living thing. Or think about our railroad, the BNSF. It is an essential artery of the American economy. Everything from the grain for your bread to the car in your driveway probably spent some time on our rails. If the cost of diesel fuel goes up, or the cost of steel for the rails goes up, we have to charge more to ship a container from Los Angeles to Chicago. And our customers, the big companies that make everything you buy, they pay it because they need to get their goods to market. The earning power of the railroad is inflation protected. Now contrast this with the bond. A bond has zero pricing power. A 10-year Treasury bond with a 4.5% coupon will pay you $45 per year on every $1,000 you invest. It will pay you that in year one, and it will pay you that same $45 in year 10. It does not care if the price of gasoline has doubled. It does not care if your property taxes have gone up 50%. Its payout is fixed. It is as a sitting duck for the tapeworm of inflation. It's a frozen, static contract in a dynamic, changing world. A wonderful business, on the other hand, is a moving target. It can protect itself. And by owning it, you protect yourself. So the single most important question you can ask about any investment for your retirement portfolio is not, is its price stable? The question is, does this asset have the ability to increase its earning power over time to overcome the effects of inflation? For a bond, the answer is an emphatic no. For a piece of good farmland, the answer is yes, because the price of corn can go up. For an apartment building, the answer is yes, because rents can be raised. And for a wonderful business, the answer is a resounding yes. I want to touch on gold and silver here for a moment because I know it's on many people's minds. Precious metals have been a store of value for thousands of years, and they can be a component of a strategy to protect against currency debasement. But a piece of gold is not a productive asset. It sits there. It does not produce anything. It does not pay you dividends. It does not innovate or hire people or create new products. A great business, on the other hand, is a productive asset. It is a claim on a slice of future human ingenuity and productivity. It grows, it earns, it compounds. Gold is a defense. A business is an offense. And in the long run, a good offense is the best defense. This requires a fundamental, gut-level shift in mindset for seniors. It requires you to see that a stock certificate in a great company, a company with a strong brand, a dominant market position, and a product that people can't or won't do without, is actually a far more conservative, far safer long-term holding for a retiree than a government bond in the current environment. Yes, the stock has volatility. Mr. Market, as my friend Ben Graham used to say, will have his mood swings. He will be euphoric some days and terribly depressed on others. But the underlying earning power of the business in real inflation-adjusted terms is what will protect your purchasing power over the next 10, 20, or 30 years of your retirement. The bond offers the illusion of stability, but the reality of decay. So, how do you put this into practice? I promised you a clear, actionable framework. And here it is. It's not complicated. It's based on simple common sense. It's a 3-step process to begin rewriting your own playbook for this new era we find ourselves in. Step 1 is what I call the personal reality check. This is the most important first step. You need to ignore the government's CPI numbers and figure out your own true personal inflation rate. Get out a notepad. Draw 2 columns. On one side, list your major expenses from the last 12 months' healthcare premiums and out-of-pocket costs, property taxes or rent, groceries, gasoline, and your utility bills. On the other side, find the numbers for those same categories from 2 or 3 years ago. Do the simple math. The percentage increase is your real inflation rate. It might shock you, but you cannot fight an enemy that you do not see. This step makes the invisible enemy visible. Step 2 is the portfolio X-ray. I want you to look at your investment statements, not for the total dollar value, but for the composition. Get out another piece of paper and draw 2 buckets. Bucket A is for assets with fixed nominal returns. This includes your bonds, your CDs, your fixed annuities, and the cash sitting in your savings account. Bucket B is for assets with variable inflation, protected earning power. This is primarily your stocks and good businesses, and maybe some real estate if you own it as an investment. Now, do the honest accounting. What percentage of your total nest egg is sitting in bucket A? If that percentage is very high, say 50% or more, you need to recognize with clear eyes that you have a significant portion of your life savings in assets that are mathematically positioned to lose purchasing power over the next decade. This isn't about panicking. It's about diagnosing the problem clearly and honestly, like a doctor reading an X-ray. Step 3 is the slow, deliberate tilt. I am not, under any circumstances, suggesting that any senior should call their broker tomorrow, sell all of their bonds, and put everything into the stock market. Absolutely not. That would be foolish and reckless and would expose you to the whims of Mr. Market's short-term mood swings. What I am suggesting is a gradual, thoughtful, deliberate reallocation over time. It means that as your old bonds mature, instead of automatically rolling them over into new bonds that are still losing to inflation, you consider putting that capital to work in a simple, low-cost S&P 500 index fund. An index fund is a wonderful invention. It allows you to own a tiny slice of the 500 biggest and best companies in America all at once for a very low cost. It's the simplest way to own a piece of the American enterprise. This process means that any new money you save or invest should be tilted heavily towards bucket B. It's a process of slowly and steadily increasing your ownership of productive American businesses and decreasing your reliance on fixed income instruments that are fighting a losing battle. For some people, that might mean shifting from a 40% bond allocation to a 30% allocation over a few years. For others, it might be a different ratio. The key is the direction of the change. You are slowly and deliberately tilting your ship to sail with the new wind, not against it. Look, this is not an easy message to hear. I know it isn't. It goes against a lifetime of accumulated wisdom. It challenges the very definition of safety that has been drilled into us by the financial industry for half a century. But the facts are the facts. And arithmetic is a stubborn thing. It doesn't care about our feelings or our traditions. We cannot invest for the world of 1995. We must invest for the world of 2025 and beyond. And that is a world where the preservation of purchasing power is the only game that matters. Your greatest asset as an investor is not a hot stock tip or a complex algorithm. It's the right temperament. It's the ability to think calmly and rationally when others are either fearful or complacent. And the current complacency around the safety of bonds is, in my opinion, one of the great unrecognized risks for seniors today. The real risk is not seeing your account value fluctuate from month to month. The real risk is arriving at age 85 or 90 and discovering that your savings, which looked so adequate on paperback at age 65, can no longer cover your basic living expenses with dignity. That is the terrifying outcome we must all work to avoid. And the best way to avoid it is to be a long-term owner of businesses that will be selling more goods to more people at higher prices 10 and 20 years from now. By hitching your wagon to the dynamic, adaptable, and perpetually growing engine of American enterprise, you are giving yourself the best and perhaps the only defense against the silent ravages of inflation. It requires patience. It requires you to endure the occasional scary headline and market downturn. But it aligns your financial future with the most powerful wealth creating force in the history of the world. And in this new era, that's the safest place I know to be. Thank you for your time.